The world watched with bated breath as stock tickers flashed crimson red. Asian markets plummeted. The Nikkei, Japan's leading index, plunged by a staggering 8%. Hong Kong's Hang Seng Index fared even worse, nosediving by an alarming 9.4%. This financial earthquake was no act of God. It was the direct result of a burgeoning trade war between the world's two largest economies, the United States and China. The conflict, long brewing beneath the surface, erupted with the force of a volcanic eruption. On April 2, 2025, the United States, under the leadership of President Donald Trump, dropped a bombshell. The administration announced the imposition of sweeping tariffs on a vast array of Chinese imports. Some of these tariffs were as high as 50%, a move designed to protect American businesses and workers, according to the White House. This aggressive action marked a significant escalation in the ongoing trade dispute, sending shockwaves through the global economy. Businesses, investors, and governments worldwide braced themselves for the fallout. China's response was swift and decisive. Beijing refused to be cowed by what it perceived as an act of economic aggression. Within 48 hours of the U.S. announcement, China retaliated with its own set of tariffs. On April 4, 2025, China imposed tariffs averaging 34% on a range of U.S. goods. This tit-for-tat response targeted key American exports, including agricultural products and automobiles. The message was clear: China would not back down from a trade fight. The back-and-forth tariff volleys ignited a firestorm of uncertainty in the global marketplace. Businesses, caught in the crossfire, scrambled to adjust their supply chains and pricing strategies. The specter of a full-blown trade war, with its potential for devastating consequences, loomed large. With each round of tariffs, the stakes rose higher. The economic conflict threatened to spill over into other areas of the US-China relationship, further straining ties between the two global superpowers. This trade war, while explosive, was not entirely unexpected. It represented the culmination of years of simmering trade tensions between the United States and China. For decades, the US-China trade relationship has been characterized by a complex interplay of cooperation and competition. China's rapid economic rise, fueled by exports, led to a massive trade imbalance with the United States. American businesses and policymakers have long accused China of unfair trade practices, including intellectual property theft, currency manipulation, and forced technology transfer. These concerns, coupled with a growing trade deficit, created a fertile ground for protectionist sentiment in the United States. The Trump administration came into office promising to address these trade imbalances and protect American jobs. The imposition of tariffs was a central plank of President Trump's America First agenda. However, critics argued that these tariffs would harm American consumers and businesses, ultimately proving counterproductive. Section 4: Global Markets Reel. The immediate reaction from global markets to the escalating trade war was one of sheer panic. Investors, fearing the worst, dumped stocks and sought refuge in safe haven assets like gold and government bonds. Asian markets, heavily reliant on trade with both the United States and China, bore the brunt of the initial sell-off. The Japanese Nikkei and the Hong Kong Hang Seng indices experienced their steepest single-day losses in recent memory. European markets followed suit, with major indices opening sharply lower as news of the trade war spread. The Euro Stoxx 50, a key barometer of European equities, tumbled by over 3% in early trading. The US stock market, although closed on April 2nd when the tariffs were first announced, was not immune to the global contagion. US stock futures pointed to a sharply lower open, signaling that American investors were bracing for a turbulent ride. Section 5: Economic Shockwaves. The trade war between the US and China sent shockwaves throughout the global economy, threatening to disrupt supply chains, increase consumer prices, and dampen economic growth. The impact was felt by businesses, consumers, and investors alike. One of the most immediate and visible consequences of the trade war was the potential for higher prices on a wide range of consumer goods. Tariffs, essentially taxes on imported goods, were expected to be passed on to consumers in the form of higher prices. The trade war also threatened to disrupt global supply chains, which had become increasingly interconnected and complex. Businesses that relied on components or finished goods from China faced the prospect of higher costs, production delays, and potential shortages. the uncertainty surrounding the trade war cast a long shadow over the global economic outlook. The International Monetary Fund, or IMF, warned of the risks to global growth, urging both sides to resolve their differences through dialogue and negotiation. Section 6. Voices of Concern. As the trade war escalated, a chorus of concern emerged from governments, international organizations, and economic experts worldwide. They warned of the potential for unintended consequences and urged a swift resolution to the conflict. The International Monetary Fund, or IMF, expressed deep concern over the escalating trade tensions, warning that the tariffs would harm both the US and Chinese economies, as well as the global trading system. Christine Lagarde, the managing director of the IMF, cautioned that nobody wins a trade war, emphasizing that the tariffs would ultimately hurt consumers and businesses in both countries. She urged the US and China to engage in constructive dialogue to resolve their differences. The World Trade Organization, or WTO, also voiced its concern over the trade war, warning that it threatened to undermine the rules-based multilateral trading system. The WTO Director General Roberto Azevedo called for restraint and urged the two countries to abide by their WTO obligations. Section 7. Navigating Uncertain Waters. The US-China trade war created a climate of uncertainty and volatility in the global economy. Investors, businesses, and consumers alike were left grappling with the potential ramifications of this high-stakes economic conflict. For investors, the trade war injected a significant degree of risk into the financial markets. Stock markets became more volatile, and traditional safe haven assets like gold and government bonds gained in popularity as investors sought to protect their wealth. Businesses, particularly those with significant exposure to international trade, faced difficult decisions. They had to weigh the potential impact of tariffs on their costs and supply chains, and consider whether to adjust their sourcing, production, or pricing strategies. Consumers too felt the effects of the trade war, albeit less directly. The tariffs, if passed on to consumers, had the potential to raise prices on a wide range of goods, from electronics to automobiles to everyday household items. In these uncertain times, it was essential for individuals to stay informed about the latest developments in the trade war and to carefully consider the potential implications for their personal finances and investment decisions. Diversification, long-term thinking, and a focus on financial planning remained crucial strategies for navigating the turbulent waters of the global economy.